Welcome to Convince Me in 15 Minutes. This podcast will introduce you to concepts, theories, and philosophies in the world of finance, investing, and wealth management explained in 15 minutes. Your guides are Keith Thompson and Luke Tawas.
Hi, my name is Jonathan Blau. I'm the CEO of Fusion Family Wealth, and I'm here today to convince you that in the long run, real life returns are determined far more by investor behavior than in investment performance.
Welcome. Today we have Jonathan Blau. He is the founder and chief executive officer of Fusion Family Wealth, a Long Island-based fee-only registered investment advisor. His investment philosophy is centered on helping shape money behavior and teaching wealthy people to consistently make rational financial decisions under uncertainty.
Believe it or not, as successful as an investor may be in their professional career, entrepreneurs, executives, etc., we typically, as a society, don't understand the difference between money and currency. So if I hold up a $100 bill during a presentation and I say to the group, in one word, tell me what I'm holding up, 99% of the time, or the people say you're holding up money. And it's not money. It's actually a currency unit, which is probably a peerless medium of exchange, so that if I sell oranges for a living, I don't have to go to the person who sells Teslas and say, how many oranges do I need to give you? I give him that currency unit, and we understand that's the medium of exchange that makes that transaction work. But real definition, as far as we're concerned, of money is purchasing power. Right? If I perfectly preserve 1 million currency units, dollar bills, for 10 years, I haven't done a good job, because in 10 years, I might need 1.2 million to buy what 1 million used to buy me. And certainly in 30 years, I'm going to need 2.5 million. And perfectly preserving those, the number of dollars I have doesn't do anything about losing the value of each of those dollars to inflation going up at 3% each year compounded. So just by misdefining money and currency, we're led to believe by the industry that, hey, we need to protect against the second thing that's identified here. We need to protect against the fluctuation of our dollars, the value of what we own fluctuating, or they call that volatility in the industry. But by telling us we need to protect against that, the method that they recommend to protect against that is to incorporate a good portion of what are called bonds, or investments that freeze the level of the income we get from them. So if I'm getting 3% today and the bond comes due in 10 years, in year 10 I'm still getting 3%. But because of inflation, I need a lot more than 3% in year 10. Never got it. At the same time, the bond is freezing my principal. If I put 1 million in year 1, in year 10, I still have 1 million. The problem is I need a lot more than 1 million to buy what 1 million used to buy me. So by telling me to protect against volatility or fluctuation in the value of market price of my investments, and solving for that problem that's not a real problem, the solution is to freeze my income and principal going into 20, 30 years of retirement marked by 3% compound increases in the cost of things I need to buy and want to buy. What they're doing is they're actually killing my money, my purchasing power, by protecting against a risk that's not the real risk. So the industry tells us define risk and safety in terms of protecting principal. We need to define risk and safety in terms of protecting purchasing power. And so investments like bonds actually destroy our wealth that way. And investments like equities, like the S&P 500, for example, whose dividends grow for the last 80 years at about 6% a year, not just keeping up with inflation, but twice the rate of inflation, and whose prices grow well beyond that. So that's really what it is. And just to use an example, when I was born in 1960, the consumer price index was about 30, and today it's about 300. So inflation means that when I was born, to buy what $1 million bought then, I would need 10 million. Inflation's gone up tenfold. In bonds, if I bought a bond, even if it was giving me 10% a year tax-free in 1960 and it matured today for $1 million, I get back my million. I need 10 million. I'm broke. I just don't realize it. I still have my original million, but I need 10 million to buy what it used to buy, and I'm broke. In equities, the equity market was 60 in 1960. Today, the S&P is 4,300 or so. So my million is 70 million. I don't have the 10 million that I need to buy things that a million used to buy. I have 7 times that amount. The dividends were $2. Today they're 70. So if I was getting a 3.5% yield back then, which is about what it was on my million, my 35,000 in income then today has gone up about 35 times. I'm making $1 million on my million. The last year that bond that was paying me 10% tax free paid me was last year. I was getting 100,000 instead of $1 million in dividends. So that's an example of what the industry advice can do to kill wealth. So the belief system we talked about, again, not understanding currency and money and the difference. And then because of that, misdefining risks and safety in terms of protecting principal instead of the need to protect erosion of purchasing power. The value of the dollars instead of the number of the dollars we have is what's important. So the next thing is our behavior system. The first behavior that is detrimental is something that's actually autonomous. We can't even control it. It's not emotional. It's physical. And it's these two little organs at the base of our brain called the amygdala. They're our fear sensors. So if we were roaming the African savanna a 250,000 years ago as two hominids, because we weren't humans back then, and we heard a rustle in the bush, first guy said, it's just the wind. Second hominid screamed, lion, and he was in the next county in 3 seconds. We descended from that hominid. We didn't descend from the guy who thought it was the wind because his head got bitten off. And so the amygdala developed over the years to be more sensitive and quicker responding, but through evolution. And so now it doesn't know the difference, the amygdala, between the threat of a lion or the Dow Jones or S&P going down 30%. And so the protection mechanism says sell, do the opposite of what we should do. We should be buying more of what's on sale for the future, retirement, not selling it. The second piece is an emotional response. So loss aversion bias is one of the most prominent emotional responses we have that's destructive. And what it does is a guy named Thaler won the Nobel Prize years ago for proving that the pain of a loss to us is felt 2 to 2.5 times more than is the pleasure of a gain felt pleasurable. So what we do is we try to avoid the losses. And the way we do that is if we have to raise money from a portfolio and we have investments that are down, we'll keep subpar investments that we might never even buy today with new money, just because selling them ignites that 2 to 2.5 time pain sense. And then we say, all right, well, I have the loss. I'm going to sell the winners so I don't feel that pain. So we leave ourselves with a subpar portfolio. And even more destructive, what that 2.5 times greater feeling of pain versus pleasure does is it eliminates our ability to distinguish between temporary declines in the value of our investments versus permanent losses. In an S&P 500 type diversified portfolio, there's never been anything other than a temporary decline. The only way we get a permanent loss is when it's humanly manufactured by us selling into the temporary decline. Permanent loss is something that the markets have never themselves in that way been capable of producing for us. And most people believe that not only is it capable, it's going to happen to them eventually if they invest in stocks. They're somehow going to have a permanent loss. That's the risk they fear rather than the risk of purchasing power erosion, the real risk. The third thing is economic behavior, and this one always fascinates me. So we're pretty rational economic beings. We're attracted to goods and services when their prices are falling. We want to buy more of them. And when their prices are rising, we want to buy less of them or postpone our purchase. And we behave that way with almost every financial and economic input except one, the price of our stocks. When stock prices and the price of the companies we want to buy are high and rising, human nature thinks that the risk of buying them is now decreasing rather, and that the future opportunity, buying the future earnings at higher prices somehow is going to yield a higher return than if we bought them at lower prices. Conversely, when stock prices are low and falling, human nature thinks that the long-term enduring values of the companies are also permanently falling, and that the risk of buying these great companies at lower prices is somehow increasing. And what we try to teach our investors is that reality isn't different than what human nature thinks. It's the opposite. Right. So when prices are falling, the risk of buying them is actually decreasing, and the future value that we're buying is increasing. So those are the things that we need to help people understand, which is both counterintuitive to them and countercultural in many ways. So what's the cure? What's the way to solve for these issues? Okay. So simply, let's help people understand the real risks. We already talked about to me, the most significant risks is the erosion of our purchasing power over a lifetime. The next risk I call sequence of return risk. So someone might say, well, Jonathan, if we have too much money in stocks and the market goes down like it did in February to March of 2020, and I have to live on that money, now I have to sell the stocks at a loss. So that's called sequence of return risk. When does the decline occur relative to when I invest my money? The way we solve for that is we advise clients to take 2 to 3 years living expenses and put that in cash or bonds. Cash if you're not getting paid to own bonds like 3 or 4 years ago. Bonds if you can buy short-term bonds and get a high yield like you can today. But either way, the return on those investments, cash or bonds, isn't what's relevant to the long-term plan. What's relevant is that money should always be there without moving too much so that we can switch to drawing upon it when the markets have a 25 or 30% decline, called the bear market. So that's sequence of return risk. That's how we protect against it. So in our model, what we help clients do is someone has 10 million and they're spending, let's say, 400,000 a year. 3 years of that spending is $1.2 million. We would tell them to have about $1 million outside of stocks. $1 million on a $10 million portfolio would be 10% in bonds. Our industry would say, oh, no, the 65-year-old person can't have 90% stocks, because they still think you should be having bonds, maybe another 30% of them, to protect against this false risk called volatility or fluctuation. And they'll proceed to give you, in our case, an extra $3 million in bonds for that client, that if it were in stocks, net of inflation returns over 30 years at 7% a year, that extra $3 million that the industry tells you to place in bonds would potentially grow to 24 million in 30 years, whereas the bond would still give you back the 3 million in 30 years. So it's really destructive, those kinds of approaches, in our view, to have bonds for the purpose of fluctuating principal preservation. And then concentration risk is another big risk. So people today, for example, are investing in the S&P 500 traditional weighted. They don't recognize 7 or so companies take up the majority of their investment dollar, from NVIDIA to Facebook and Apple and Microsoft and so forth. Stocks that this year may have returned 30 to 200% at one point during the year and trade at 30 times earnings. We're, again, in the last behavior I talked about, being attracted to economically stocks when the prices are getting higher. That's what's happening here, and they're going through it as we speak. They're chasing those things. So by taking a diversified approach, taking a portfolio and having those kinds of companies along with companies that are selling at a discount to their current value, as well as international companies that are selling at different prices than U.S. companies and moving differently over time. And then when a client is adding money to their portfolio, their instinct would be to chase those 7 magnificent stocks I mentioned, leading the S&P, the NVIDIAs and so forth. But what we do is, the way we cure that is, we're always giving to what's cheapest first. So it might be international, might be emerging markets this year, and then filling up the bucket. And what that leads to is fighting that last economic misbehavior problem, which is we're doing the opposite. We're buying barrels full of things when they're cheap, our way, by diversifying and rebalancing properly, and we're buying thimbles full of what's expensive, the opposite of what human nature wants to do. And then finally, behavioral risk covers all the risk. I call it the risk of the big mistake. So if a client is paying a fee to us, we tell them one of the big ways that we like to look at our fees is you're paying it's like insurance, except you don't have to die to collect it. All that has to happen is we help you avoid selling out into the panic of 2008. We'll earn that fee by an order of magnitude just on that one behavioral interference that we have with you that one time, and we'll have many over a whole lifetime of fads and fears. And so when you cover all those real risks, so the solution broadly developed a goal-focused, planning-driven investment policy, as opposed to a policy that might be presented by many industry advisors, which is, hey, we're going to help you find what's called alpha. We're going to find funds or investments that outperform the S&P 500. We're going to use our phalanx of analysts and economists to tell you which sectors and industries you should be getting into and out of and when. And we're going to forecast the economy and hoping from what we learned from our forecast, tell you when to get in and out of the markets. Timing the markets or any manner of what I call timing and selection, which is what I just described, is impossible for anyone to do consistently. So we're proud to tell people we don't try to do it. And also, we believe it's irrelevant. What's relevant is to not find what's going to do the best for the next year or two, but to find the best return that one can stick with for the longest period of time, which is called compounding. So compounding, really, I look at it as simply returns, if you can get 7% a year, to the power of time for the next 30 years. And as I said, in 1960, the S&P was 60. And from the returns of the S&P, the returns not including dividends, maybe 7% or so a year, you turned $1 million into 75 million. Didn't require 15, 20% a year returns to beat inflation, which would have turned $1 million into 10 million by a wide margin. So through all of these strategies and teaching people something that's hard for them to hear sometimes, that what you need to do is actually countercultural and oftentimes opposed to everything that you learn, the opposite of what you need to do. If they listen, though, we believe we can help many people find success.
And Jonathan, in the last 25 years, I believe every calendar year, the S&P at some point has gone down. But in most instances, by the end of the year, it's finished positive. So do you have these conversations on an ongoing basis with clients? And I assume the longer they've been with you, the more comfortable they are with volatility.
That's a good question. So one of the things, one of the tenets of my belief system is that you have to educate investors on what to expect, because I always believe that surprise is the mother of panic. And so to your point, JP Morgan's Guide to the Markets recently shows what they've shown every year, which is since, I believe, 1980, the average intra-year move down from a peak to trough in the S&P has been about 14%, right? So since 1980 or so. So I tell people, if you can't watch about 15% of your stock money appear to disappear each and every year, and worse, the market goes down. Average bear market happens once every 5 or 6 years, so down about 33. So if you can't watch it appear to disappear to the tune of 15% a year, and twice that amount 1 year and 5 or 6, you can't be an equity investor. It's that simple. And then we have periodic newsletters that reinforce all these messages to avoid surprise in the future. And we call that our vitamin C. Just like the body can't store vitamin C, they can't store the information, the positive information we give them once they leave our office or get off the call and turn on what I call the poison at CNBC that's filling their brains with toxicity. They start, all of the vitamin C we just gave them starts to erode. We gotta give it to them again.
When you were talking about your process, you talked about the collective we and unpacking their fears. I think probably one of the more challenging things is when you're talking to a we, husband, wife, whomever, their indistinct, separate kind of perceptions of risk may differ dramatically. How do you balance that?
No, it's a good question. And often it's very seldom that two people come to the table with the exact same perception. But broadly speaking, they all have the same perception, meaning very few of them view that their big risk is the erosion of purchasing power. In one form or other, they view that stocks, I've always been taught, are risky because you can lose your money during a bear market or a decline. In some form or other, that's generally the dominant fear as it relates to risk. Very few of them could even articulate sequence of return risk, right? And why I should have bonds for that reason. So they may have other fears outside the portfolio, but when it comes to investment risk, I find overwhelmingly most people's risks are in that one way the same. They fear they can lose because they're going to invest in this thing called stocks that they know have declined a lot, particularly in their lifetime. People who were born in the 60s have lived during periods, even though they weren't aware of all of them, where the market has halved or more 3 times. According to Charlie Munger, Warren Buffett's partner, that typically happens twice in 100 years, a halving. So 1973, 4, half, 2000 to 02, half, and only 6 years later, 2008, 9, 60%. So having lived through that, and then seeing, wow, but also since I was born, having halved 3 times, gone through maybe 9 or 10 recessions and 10 or 11 bear markets, my investment that was $1 million when I was born would have been worth 70 million today. Guess this thing works. I don't know what risk they're talking about, right?
I'm always intrigued by the second thing on the slide, which is the emotional behavior. I think everyone probably knows the saying, buy low, sell high. But Jonathan, why do you think it's so difficult for people to actually execute that? Is it because they constantly want to chase what's doing well? Is it that they project what's recently happened into the future? It's just, amazing. Buy low, sell high seems such a simple statement, but it's very difficult to execute.
No, it's a great point. And think about this. I always have had a weight problem. Take in fewer calories than you burn. Simple, right? Simple. Just not easy because I'm tempted by the cheesecake and the cookies, right? Same thing with investing. It's simple. It's easy to understand. But human nature is always and everywhere a failed investor. It's immutable. It doesn't matter how smart you are, how well educated you are. If I said to you, there's 10 people that are in my office today, is any one of them less likely than the other, regardless of their education, business success, etc., to have chased every dot-com stock going into 1999 and sold every value and international stock, which would perform better the next decade than those stocks they were diving into? Is any one of those 10 people more or less likely than the other to abandon everything to chase the dot-coms? And if anyone says, there are more or less, no, they're all the same. It's human nature is immutable. So why do people do it? For example, all these behaviors. One example is we extrapolate. Extrapolation, and that's related to a bias called recency bias, is a killer. So if for the last 7 years large cap U.S. stocks have done the best, our mind sees a pattern. That, wow, that's where I should be, because our mind says, based on that recent pattern of 7 years, recent in a lifetime of a 30-year investment plan, that's a short term. Based on that 7 years, my mind says there's a future predictable pattern, right? When it's not, there is no predictable pattern, but that's what the mind thinks. And so then because of that recency bias, we extrapolate that recent pattern outward and we chase it. And so one thing I can tell you from history, the way we help clients fight this, just teach them history. Because they like Truman said, the only thing new in the world is the history you don't know. So in leading up to 2000, everyone was chasing large cap companies, and particularly the subset that was technology. But different than today, it was different names. It was WorldCom, it was AOL, it was Lucent Technologies, Cisco Systems, as opposed to NVIDIA, Apple, and Facebook, et cetera. And what they did is they sold all the value stocks, all the international, all the small caps to buy more of the WorldComs and the dot-com constituents. And when they did that, what they did is they put everything they had at the worst possible time into what had recently done for 7 to 10 years, just like they're doing today. And what happened over the next 10 years is the S&P without dividends lost close to 30%. And the other stuff, especially emerging markets, made during that period at 200%. So they denuded their portfolio of the things that were about to have a 10-year run to get into the things that were among the most expensive they could be, that were about to have a lost decade. I see a lot of the same patterns today if you look at where the different diversification pieces lie.
So we should all be George Costanza, do the opposite of everything that we think we should be doing.
Yeah, we should live in bizarro land if we're investors, right? That's what we should be doing. Just do the opposite.
And I've always felt that recency bias is the greatest killer of wealth.
Along with extrapolation, right? Because that's the killer. We extrapolate. Yeah. We extrapolate good and bad.
Well, there's a Warren Buffett quote that I'm going to get wrong, but you'll get the gist of it. He said that the stock market is a means of moving wealth from the impatient to the patient, where we want to sell our value at the end of the 90s and buy growth, and probably the same here. But one of the things that you mentioned has seemingly had a decade of just absolutely horrible returns, and that's international. Nobody wants to put money in international. Is that maybe somewhere where they should be looking right now?
We think so. We think so to the tune of we allocate about a third of our client portfolios there. I mean, again, international, last statistics I looked at are selling roughly at about 12 times earnings as a broad index versus 18 to 20 on the U.S. The dividends are about double the U.S. So all the indications are that I'm getting a lot more shares for a lot more value over there. And the thing that I find interesting is people try to justify the recency bias. And by the way, with international, there's another bias involved called home country bias, which is a version of familiarity bias. We tend to like to buy and invest in things we're familiar with, believing irrationally that those are going to always help us more and hurt us less than things we're not familiar with. And in international stock investing and avoiding them, it's called home country bias. There was a study done a number of years ago where they looked at the Australian Stock Exchange. And at the time, Australian stocks accounted for 1% of the value of stock market values worldwide, yet the average Australian had 77% of their stock money in Australian stocks. That's how powerful home country and familiarity bias is. Now, a lot of clients will try to justify the behaviors that they might not understand are leading them to these generally bad long-term investment decisions to avoid international or anything else that's not that's underperformed for a period of time. And what I mean by that is they'll say, hey, isn't it risky to have a third of our money in international? I say to them, well, let me rephrase the question. Do you believe it less risky to have 100% of your money invested in one country? Or do you think it's less risky to have at least a third of it spread out over maybe 30 or 40 more countries? Which one seems more risky if you put it in those terms?
Jonathan, can we spend a little bit of time on purchasing power? I think everyone's getting reintroduced to inflation in the last couple of years.
Sure.
What are some ways that you talk to clients about inflation?
So we talk to them about the idea that what did you pay? What did you pay for your car when you bought your first car? How much do you pay today for the same kind of car, for a car? And they might have paid $2,500, and today they're paying $60,000. You try to make it real for them. How much did you pay for a box of cereal when your kids were growing up? How much do you pay today? Postage stamp, right? Paid 5 cents. Today I'm paying how much? So that's kind of how we like to make inflation more tangible for them in that regard.
Anyway, Jonathan, I can't thank you enough for joining us today. I think both Luke and I are in your camp on this. You could have the best asset allocation in the world, but if you have clients who can't endure the volatility associated with it, it doesn't matter because they're not going to be there to benefit from it. So I think the way you're running your practice probably serves your clients very well. We can't thank you enough for joining the podcast today, and we certainly look forward to talking to you again in the future. So thank you very much.
Yeah, thank you very much, Jonathan.